trading, knowledge is power, and lack of knowledge in what you're doing can be costly, very costly. So you need a solid foundation of quality market education. Whether you're new to trading or a seasoned veteran looking to add advanced strategies to your arsenal, there's always something to learn and something to improve on. And now you can access the same knowledge that professional traders receive with Market Rebellion's Trading Education. I'm Bill Johnson, Head of Options Education here at Market Rebellion, and we've assembled a comprehensive curriculum based on decades of real trading experience, covering everything you need to know about trading options from beginner to advanced. We go way beyond the nuts and bolts of options theory to teach you how to apply specific trading strategies and the techniques needed to adapt your trades when markets shift. Regardless of your goals, you'll gain access to the education you need with easy-to-consume lessons so you can learn to trade with confidence, enhance your knowledge, and master the practical skills required for market success. So please join us for in-depth trading education only from Market Rebellion. Hey, good afternoon, Market Rebels. It's that time. There's the closing bell, Stu. And it's that time again for Coach's Corner. And today, Stu, I've got a really cool topic. We've talked about it briefly in some of our Q&As, and that's what kind of prompted me to do this, because there's a lot of misperceptions about stop orders. I want to get up front that we are not saying that they're bad, right? Lots of people use them, but we think that a lot of people use them for the wrong reasons. And that does become a problem.
Agreed. Not just that, they don't really understand the mechanism of how it works, and
we're going to talk about all that. Yep, we're going to show it, and then we're going to show why you have to be careful about your interpretations of them. So let's start off with our little chalk talk question for everyone. If you're new, it's great having you here. We like to put these up in the front as a little thought-provoking question. We'll answer it at the end. But right now, should you use stop orders, whether a stop order or a stop limit, as a substitute for put options? And this is the question that we hear from a lot of people saying, oh, don't bother with a put option to protect, let's say, a portfolio or a position. Just put a stop in. That's the question.
Let's just make clear here for everybody, Bill, that we're talking about if you're earning upside, if you're earning up, long stock or long calls, right? The opposite can be, it's the same idea, right? If you're short,
exactly.
Right, you could stop it out to the upside, but it's all the same idea. We're just using the example of
correct.
A long call. How do I stop it at?
Because that's mostly what most people are.
Yeah,
it's a good point. For every action in the market, we have a bullish and a bearish, kind of like a yin and yang. Same with candlesticks. There's a bullish, a bearish. For the strategies, there's one that can be built with calls and puts. So yeah, we're going to talk about it from the long position side and guarding the downside. But if you're short, exactly the same argument to the upside. So the topic for today is a stop order the same as a put option. Now, when we obviously they're not the same, but what we mean is, can you use them as substitutes in the sense that a stop order is guarding that downside? That's what people think.
Right.
And they go, well, hey, if I buy the shares and I buy a put option, I've guarded off or blocked off any risk to the downside, but I had to pay for that. And if the stock sits still or goes up, I kind of wasted that insurance. Why don't I just throw on some stop orders for free? Because if the stock goes down, I'll block it too. I'll get out.
But you mean my broker doesn't charge me to put a stop order in?
We're going to talk about that. It's a good insight. That's right. So before we get started, quick reminder for everyone right there, marketrebellion.com/get started. Look at that, Stu. 40 courses, over 40 courses on topics just like this to help you get started. So let's do a quick review of stop orders, because I think that's where a lot of the confusion starts. There are two different categories, but stop orders are generally used defensively to limit risk. I say generally because we can use them offensively as a way to get into a position.
For
But
sure.
generally, we're saying I bought a position, I want to get out if something happens, if the stock
Mhm.
hits, let's say, a certain price level.
Or you
So for
down a certain amount of money, or, anything where you say, "Oh, this is not working, I want out."
and that's not working, I want out. So for a long position, and a position that you buy, generally what you would do is you would place an order to sell below the current market. So the stock's at 100, you might place an order to sell at 95. That's would be a type of stop. As Stu said, for a short position, it would be the opposite. You'd do a buy stop above it. Because
Mhm.
if you shorted the contract or the shares, to get out you have to do a buy. So now we're just triggering a buy order.
Look at Bill all over this, way ahead of me on that. That's just
That's part. Stu doesn't see these beforehand, so it's just to get his commentary on it. But yeah, it's. I had a feeling that most people are going to have questions about this. So let's take a look at the mechanics. As you said, this is where a lot of the problems begin because people don't really understand how they work. So stop order. Let's say you buy 100 shares of ABC at 100, or that it's currently trading at 100. Right, the price you paid, you could have purchased these for 20. Doesn't matter. It's worth 100 right now. And now you think I'd like to guard that. I'd kind of like to protect this. So you place an order to sell 100 shares at a stop of 95. Generally, people would do it GTC, good till canceled. You could do it for the day as well. But the thing to understand is that the stop price right here, this 95 price, is a trigger price. That's the way I want you to think of it. It's just a way to say, hey, wake up, time to do something.
time to get in the game.
Time to get in the game. So the way that it works with this stop is that if the stock trades at or below, that is a very key phrase for a reason you'll see in a moment. What we're saying is that if it trades at or below our trigger price, the order is activated. And as you know, Stu, in the business, they actually call it elected. They would say the order has been elected.
Yep.
And if it's a regular stop order, as opposed to a stop limit, which we'll talk about in a second, then what happens is that it becomes a market order. And it means you're guaranteed to sell, but the key is you are not guaranteed to get 95. That's the big mistake where everybody thinks that they're a substitute for a put. They go, oh, I put a stop at 95. I'm going to get out at 95. No, you might get out at 95. And that's very different from saying you're guaranteed to get out at 95.
Yeah, if it's a market order, you're gonna get out at the market, whatever
You're
the
going to get out the
bid is
market.
at
And as
the
we'll
time,
see, it can
whatever it is,
backfire.
get
Yep.
out.
So here's our $100 stock, and let's say that it starts kind of dwindling down here. It's at 98, then it's at 96. It's just a touch above our stop. And then what happens? Comes down to 95. All right, so what happens, everyone? The order gets elected. It's like saying, wake up, something, time to do something. Well, what's it going to do? The computer is going to send a market order. And what's a market order? Whatever the best available price is at that time. So if that stock cap's down at 70, you're not getting 95, but you are absolutely guaranteed to get out. You're just not guaranteed to get 95. And that's the first big misperception. Now, what else could happen? You know, if the stock is trading at 95, yeah, it's going to work out well. What else could happen though? It could open up at 80. Did it get elected or activated? Yes, it's trading at 95 or below. And again, it's a
Remember,
market
that
order.
was the instruction,
That was the
right?
instruction
That
if
was the
it's
instruction.
95 or below.
Gotta
Right.
read the instruction.
So generally speaking, if it's during the day and the stock is slowly drifting down this way and you have a stop at 95, they will generally work out pretty well. Where they can really cause some unwanted surprises is on the opening bell because now it might gap down to something like this. I mean, I guess it could happen during the day. They could halt trading. That's pretty rare. It's usually going to be on the opening bell that you're going to get these unwanted surprises. Now, there's a second category. That was
Hold
a
on 1 second, 1 second. So, again, depending on how you put that order in,
Mhm.
there is day, there is GTC, there is
Right.
GTC after the, market and pre-market, there's
Yep.
GTC, So if if your instruction was GTC after the market, then that could happen like at 5 o'clock, or
It's
4:30 when an earnings
absolutely
release
true.
maybe
Good point.
comes out.
Good point.
Uh, yeah,
You need to be aware
right.
of how these
Position.
instructions work. So that
And
was
you
a
go the
regular.
next day to cancel it and it's like, oh, you already, or maybe you go to sell it because the market turned around and went back up and you don't have it anymore because you blew it out down at the bottom when it got elected, the
Right.
night before.
Yep. So that was a stop order. Remember, the key there is that it converts to a market order, and a market order is guaranteed to fill. There's a sister strategy for people who might say, I don't know if I want to take the risk of maybe getting filled at 80 or 70. Is there a way I can block against that? Well, sort of. What you can do here is do a stop limit. Notice we've added this word limit. And what you have to do on your broker's platform is specify two prices. The first one we gave it just in our example, a stop of 95. Now we're going to give it two. One is the stop price, serves the same purpose as it did before, it's our trigger. But the second is a limit price. It's going to convert to a limit order instead of a market order. So let's take a look here. We bought our shares, let's say, where they're currently trading at 100, and we placed an order to sell shares at a stop of 95, good till canceled, with a stop limit of 94. Now, the key here is that the second price, our stop limit, it can be any price. Usually people will make it equal the stop or something below if it's a sell stop. And the reason for that is if it happens to be trading down quickly, stock is at 96 and it's 95 and a half and goes 94.75, it gets triggered and they go, oh, I can't get the 95. So this gives us a little bit of wiggle room to say, all right, if it slips a little bit below my trigger, I'm still willing to take 94. But if we get prints at 95 or 94 and a half, we're still going to get filled at the better prices.
And
I think
right, exactly. I was just going to say that you will get filled whatever the best bid is at the
at
time
that time.
with a 94 limit. So if there's a 94 and a half bid, you'll get 94 and a half.
And,
That's
and we should also qualify that because remember it's an auction market. There's a list of people.
huh?
And the first person here, there might be 100 people in front of you.
There
People
might
think
be.
that say, "Oh, I saw it print at
Yeah.
94, therefore I should get 94." Well, that might have only been for 100 shares.
Yeah. Time. It's a time
Time
sequence.
priority. Yeah, exactly. So there's a
High
lot.
priority, right? The
Yeah.
orders get timestamped. We used to call them timestamps. I don't know what they call them
Mhm.
these days, but they get timestamps. And if you're behind, 5,000 shares. If you're the 5,100th share and 5,000 are bid for, you're out. You're not going
You're
to get
out.
anything.
That's right. So again, lots of moving parts in here. You have to be aware of how they work. So at any rate, we've set up our stop to trigger or to get elected at 95, and then we're saying, I only want to sell if I can get 94 or better. All right. So if it trades at or below 95, the order is elected. It becomes a limit order, and we're saying I will sell at any price greater than or equal to 94 because that's my limit. I'm just saying sell only if you can get 94 or higher. So let's see what happens here. Here's our stock. Wiggles down here. It's trading at 99, 96, comes down, trades at 95. What happens? Gets activated, but now it becomes a limit order at 94.
Mm.
So if the stock is trading here at 95, yeah, you're probably going to get 95. But you could get anything up to and including 94. You could not get 93, 99 or lower.
And just to kind of go back a little bit, imagine everyone, if you don't have a limit and it's a market order, you'll get what the bid is.
These would get the same price exactly. They're going to work the same. However,
Whatever.
where they work differently is this. So let's say that instead of triggering at 95, the stock the next day gaps down to 80. What
Ugh.
do the instructions say? If it trades at or below 95 or whatever your trigger is, your stop, activate the order,
Huh?
wake up, time to send something.
Go to the market.
We send a limit order at 94.
Oh, okay.
What
Nothing.
happens?
Nothing done.
Nothing done because the broker's saying, yes, it's an active order. You can look on your active orders. It's going to show that it's been submitted. But remember, it can only fill for 94 or higher. Right now, it's trading at 80. So did it
Right.
prevent a loss? No, it prevented you from selling your shares, but it didn't. Now you've got an unrealized loss.
Which is exactly why they stopped using the loss part on the stop
Very
years
good.
ago, right? Because it
It-
it didn't stop a loss.
that's why they used to call them stop loss orders. And technically, professionals should only refer to them as stops. It's kind of a weird term. People say, put your
Yeah.
stops in. Well, it made a lot more sense when you call them stop loss until you realize that's not what they did at all. So this is our first glimpse into why these are not the same as a put option. All right, so everybody understand the difference between a regular stop converts to a market order, stop that converts to a limit order. So now let's compare them. We've got long shares at 100. Here's our stop price of 95. And let's say the stock is down here at 90. If you place a 95 stop, converts to a market order, gets activated, you're going to fill at 90, you have a realized $10 loss. It's gone, sold. If you do a 95 stop with a 94 stop limit, what happens? Stock gaps down on the opening bell to 90. So did this one get triggered? Yes, it did. But did it get filled? Nope. You're still holding the shares because it would have to fill at 94 or higher. So now you have an unrealized $10 loss, but you're still holding the shares. But notice in both cases,
it's just like you put a limit order, and when
you
the
just
stock
put
is,
that's all you did. That's
that's
exactly
all you
right.
did. You just put a limit order in
Ju-
way
It
above
was,
the market.
it was just an automated order. Yeah.
Yeah.
So the key there is that both of them leave you with some type of loss. So sometimes I get asked, well, which one should I use? Well, for stocks, what I say is that if there's a price where you say, I don't care what happens, I just want out, then use a stop. But then take your lumps if it gaps at 60 or 40 or 30, because then ask yourself, well, is there a price where I'd rather hold it? And I'm saying, I can't imagine this thing would ever gap down to 70. I think that would be overblown. I'd rather hold my shares. Well, then probably use a stop limit with a limit down there, because that's going to enable you to do what you want it to do, is to hold your shares in that event.
Or maybe you really want to buy shares down there.
Yeah, well, right. Now, here's another little side note, little footnote that catches a lot of people by surprise. So listen up here. Let's say that you have this stop limit. All right, so we got triggered. We have a limit right now for 94. Let's say we did it GTC. And now, later on,
Yeah,
stock starts coming up.
great point.
And we're
Great point.
coming up and we're going, man,
And it's a
maybe,
month ago, and you forgot about it.
maybe I'm gonna get my money back here. And it's trading at 94, then it's at 100, that's at 110. We're going, I am so glad I put that stop limit in. And then there's a buyout and it's trading for 200, and you go, hey, let me sell my shares. I can't find my shares. What happened? You call your broker. Well, I'm trying to sell my shares. Where'd they go? Oh, you sold them 6 months ago. What do you mean I sold them? Well, you had a stop limit, and yeah, but it never triggered. Well, it didn't trigger on the opening. It was activated, and you had a live limit order.
So let's tell everybody here. Bill, for those of you that don't know, Bill worked for many years on an active trader desk at Schwab. He saw everything come and go, big and small, $10, $20 million, but he saw it all. This actually, I kind of remember you telling me the story. This happened, right?
Oh,
Somebody said, "Where's my shares?" And the answer was, "You sold them on a stop weeks or months ago."
right,
That's a
6 months ago.
story, right?
Yeah, and that's been more than once. There was a really devastating story that you're talking about there, but that's why it actually was incorporated into the training. We have to say, remember, you have a live limit order floating out there. So what's the moral of the story? The moral of the story is if you use a stop limit and you get triggered and you go, you know what? I don't think I'd be willing to sell them at 94 anymore. You need to cancel this order.
Yeah.
The mistake that people make is they say, well, it didn't trigger, therefore the whole thing's gone. No, it's
No,
not. You've got a
no.
live limit order sitting out there.
If it's a GTC.
Not if it's GTC, correct. Okay, so now let's take a look at where they can backfire or how they can help. Here's our stock cruising along. We hit our stop of 95. What happens? It's activated or elected. And let's say that the stock does this. In that case, we go, man, stop orders work beautifully. Why should you use a put option? But what else can happen? They could do this and then turn around and go up. In which case you're going to, oh man, those market makers, I know that they did this. I know they just threw in some bids to take my shares and they knew it was going up and now I lost my shares. So you always take the brunt of it, don't you? So, so the thing to understand here is that the success of a stop order or a stop limit depends on the path that the stock takes. They do not always work the same. So in the business, we say that stop orders are path dependent. That's what it means. The reliability of them, it depends on how that stock price performed. All a stop order does is it automates the sale. So when you place a stop, what you're really doing is you're not saying get me out in our example at a guaranteed price of 95. You're just saying just in case I'm not around, I would like to hit the sell button. And what you're saying is that I'm going to be on that red path that we saw before as opposed to the green. So there's a big element of guessing. So just because the stock's at 100 and it's trading at 95, they go, well, if I get out, then of course, then it worked well. But do we think that it's going to reverse? Some people are going to say, well, it's probably going to hit mean reversion and flip in the other direction. Some people say, nope, it's a hot stock now. It's in a downtrend, got the momentum. It's going to keep trending. I don't know. They
I don't
both
know either.
happen about 50-50.
I don't know
So
either.
really the success of a stop order is not because there's something magical about stops. It's that you got lucky and picked the path where it was a good time to exit. So keep that in mind when we look at put options.
And
Now,
also now that's behind you. If
right,
you kind of want to stay in the trade, you're just looking to flip the down tick into an uptick at the bottom. That means you have to re-enter
you'd have to re-enter.
at some point. So yeah, you have to be right twice. And statistically, what happens if you're right twice? If you think you can be right twice, right? It's even if you use that 70% thing, 70 times 70 is 49%. You're still behind the 8 ball.
You're still
So
behind.
it's a really difficult path to
To,
stay
to,
in that trade to
to,
try and
to
trade
think
that
that the
time.
stop order somehow is guaranteed to get you off of the wrong path. All right, so now what if you had instead purchased the 95 put? Well, what happens now is that this is, instead of it being our stop here at 95, that's our strike. And you can see that, the stock can drift up or below or down, do lots of different things. But are we going to get taken out of our shares here, Stu, if we have the 95 put? Because it
Uh,
triggered it. It traded at
Negative.
95 or below.
We
Nope.
have the right to sell them,
You have the right
which,
to sell them at
which
a
we paid
guaranteed price of 95,
at
not
a
the market
guarantee,
price.
which we may not elect, so
That's
to speak.
another big point. We have the right to choose. But what will we get triggered out here? Nope.
Yeah.
None of these places will we get triggered out. And so now we get to wait and see. That's why sometimes we tell people owning an option is like having a crystal ball. We get to wait and see how the future unfolds and then make our decisions. So the only thing that matters to a put option or to an option for that matter is what? That it's still alive. It just has to be alive. It has to be within the expiration date. So all of these trigger points, or that would be trigger points for a stop order, are meaningless. And so it doesn't matter to me if we ended up going on that red path down here. Who cares? I can exercise and get 95. If it dips a little bit and heads up, now I'm going to choose to let the put expire worthless and sell the shares in the market if I wanted to get out. So the thing is, the success depends on time. So an option, or in this case a put option, is time dependent. It is not path dependent. And this is one of the big reasons that Stu and I warn people when you are putting stops on options, you're mixing oil and water. You're taking a beautiful time dependent tool, such as an option, and you're putting a path dependent protection on it. They're just not a good mix. So, quick reminder again, marketrebellion.com/get started. More topics just like this. So, again, we talked about this idea of different paths. Here's a simulation in Excel, $100 stock. We have about 252 trading days. I made it 250. And I'm going to turn it loose with 20% volatility. That's the only thing that's navigating this through time is volatility. No news, nothing else. There's one possible path. There is another possible path. Well, if we kept doing this, we would get lots and lots of paths. Now, if we have 10% volatility, you can see it looks like kind of a narrow beam of flashlight. There's not a lot of spread out here because there's not a lot of volatility. It can't drift too far from its current price.
If we give it 20% volatility, look what happens now. And then at 40% vol, things get really weird. So you can see if we compare them, what's happening is that the spread, or the amount of risk, we would usually call it, grows as we have greater volatility stocks. But let's just pick one. Let's pick the 20 vol. Think of all of the possible paths in here, Stu. How many are there?
Um,
Infinite number.
how about a lot?
A lot is a very good conservative answer. There's a lot. And if we were to plot them, in other words, how many times what we call the terminal price here at the end of the year did we hit 100? We're going to put little small buckets, maybe between 99, 90, and 100.10, a little 20-cent interval. And we're going to do another one here. We're going to put all these little buckets down here. And if we counted the number of times that the stock landed in there, what are we going to get? There's our average where we would expect it to end. We would get a bell curve. And that's why we look at volatility. The volatility tells us what we can expect. So back to the stop order, think of all of these paths.
Let's qualify that a little bit here. What we can expect, and I'm actually looking at a question that somebody just asked me. What we can expect in range.
In a range, correct.
In range. It doesn't address which way
No.
the stock might be going. The volatility piece of this puzzle is what can we expect in a range? That's what the bell curve is doing, as just flip it around, kind of make the point go up, and it's a real looking bell curve. It just happens to be on its side.
Yep.
And that bell curve then gets split up into standard deviations that we call standard deviations, and they carry each of them a percentage. And that's how options get priced.
Yep. So now back to the point about the stop orders. I don't know if you can see kind of this peach colored one right here. I'm going to try to trace it out. But let's say that you're doing this. And I'm sorry, let's back it up. Let's say that we, right here, we hit that. I'm sorry, we're doing 95. All right, so let's say down here is 95 somewhere. And we get activated, we get elected. What you're really banking on with that stop order is that you're on, out of all of these cajillion paths, that you must be on one that is going to do this. And that is absolutely 100% mathematically false.
Bill,
For every path that does this, it's called the reflection principle. There absolutely has to be one that did this.
Are you showing something when you say this? It's not really.
I am. Oh, you're not seeing the drawing on there?
No.
Oh, very strange. I'm sorry for that. Let's do what I was showing is let's see. Let's just go back to.
Bill's got this new laser pointer toy. He got all the toys.
I know. Why can I just get?
Bill has.
So at any rate, what I was doing
has this laser pointer right on the mouse.
So what I was saying is that if you kind of watch this peach one, let's say we come down here and we get triggered at 95. What you're banking on with a stop order is that out of all of these paths, you must be on the one that's going to do this. That's mathematically not true, because for every one that does that, there is a reflected one that does this and does the exact mirror opposite.
Now, think of the probability you picking the right.
It's probably a 50-50 shot that you pick the right one. So why do people do it? Risk aversion. They're so fearful of these losses that they say, just get me out. I'll move on to something else. And then half the time they regret placing that stop. Very different from an option. So let's take a look at our bell curve. Here is the big problem that I have with the stops. And again, I'm not saying they're bad. They're used for the wrong reason. People think that, here I use 90 for a stop for an example. The stock is at 100. That's the center. We placed a stop at 90. So in their mind, we have blocked off all prices below 90. And that is not true. A stop order cannot alter this bell curve. The stock doesn't know that you placed a stop order, and nor does it care. It's reacting to buys and sells. It's reacting to news. You have not altered the left-hand side.
It can alter your participation.
Oh, it absolutely.
In that movement
right.
within that bell curve, but it
won't automates
change
the sale.
Right.
That's correct. That's all it did. And again, we're not saying it's bad. Where it's bad is if you think that it's chopping off this red area. It's not. You are absolutely every bit as susceptible to this red area before the stop and after. However, if you buy a put option, let's say with a 90 strike, you absolutely did chop off that part of the bell curve. Now, in
So,
exchange for that, you had to push forward because of the extrinsic value. So that bell curve gets pushed forward a little bit to this dotted line. But in exchange for that, you've absolutely eliminated all of those prices to that side.
so Bill,
So
would you say in the big world that we live in, the big bad world, that's a benefit to to being able to retain participation in the game?
very good question. And the question is, what is that? How much is that benefit worth? Theoretically, the market value of that put.
Market value of that put. And then, part two is that of that is, and this is, me being the synthetic guy again. If you own a stock and you buy that put, you just synthetically bought a call. And that's what you can use. Uh, if you're really thinking about, oh, well, I have to stop it out. Well, the
Why?
call is doing that for you.
Yeah.
You are
You bought
acting.
this call a year and a half or 2 years out. It's temporarily, think of all those paths, it's temporarily gone against you, and now you're betting that you must be on the one out of those cajillion different paths, you must be on the bad one. That's just simply not true. You're not giving it time to do what you were expecting it to do. You're getting out simply because of price. And that's a path dependent choice. It doesn't mix well with a time dependent tool. So again, there can be value in waiting. One reason for paying put option premiums is for the right to decide. Placing stops on options destroys one of the very benefits that you're paying for. So there's an advantage in waiting to see what happens because there are so many possible stock paths. So think about your reasons. All right. Stops and options turn time dependent tools into path dependent tools. Not good. They destroy the time dependent benefits, and they're not necessarily bad, but you need to consider your reasons for using them. Be sure they're not conflicting with your goals. And
Yeah,
that's what
that
we hear
last
so much in
point
Q&A.
is really important. You gotta, this all starts with what are you trying to do and what's your goal? Bill and
Yeah.
I talk about that all the time. You
I
have
think
to
the
have a
stock
goal.
is going to go from 100 to 200 in the next year or two. Why do I care that the options price has dipped from whatever that it's dipped a few percent and I say, let me stop me out? That had nothing to do with which path that you're on at all. It's a psychological comfort thing, and people feel though that they're managing risk with it. I think that's probably the best way to say it. You're not
How
really
do I
managing
manage
risk,
this?
you're managing the sale. If the stop order turns out to do good for you, stock's at 100, we get stopped out and it goes to 70, wasn't the stop. You could have just hit sell.
You could have.
It was the fact that you happened to sell at an opportune time, not because you automated it. So the question now, let's revisit that. That was a fun little tour of stop limits and put options. So should you use stop orders as a substitute for put options? Stu and I are going to say that's an epic fail. We're not saying that stops are bad, but they are not substitutes for puts. And if you don't like them for puts, as Stu said, synthetically, if you're buying calls, same difference. Just be very careful before placing those stops, thinking that you're doing yourself risk management. Any closing comments there, Stu?
I
That was
love the epic fail. Little
couldn't think of a better way to word that one.
Yeah. Yeah, it's just it's like so many things, in this options world that we do. You got to understand what it is that you're doing. You got to understand what the tool is that you are thinking about
Absolutely.
using or are using, and what it will do for you and what it won't do for you,
That's right.
and how what the other side of as well, it can help me. Well, is there a way that it could actually hurt me? Always think about like all sides of the
All
discussion, and
sides,
it
and they don't.
really help you
Yep.
to
They just
figure
say, "Oh,
out
I
what
placed a stop.
strategy.
I'm managing risk. I've got limited downside. I've got unlimited upside. What could be better?" That's not true. It's just not true, and yet so many people think that it's true. That's why we want to make sure that people understand how these things work. So we hope that that helped. Again, we always try to bring topics that we hear a lot in our Q&A classes to help all of you, whether at Market Rebellion or out there in YouTube land. But we hope that helps. For the rest of you, we will see you on um, our next Q&A class. We can talk about this. And until then, for everybody else, we'll see you next Thursday, 4 p.m. Eastern on Coach's Corner, and we'll see you then.